Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CADRE Holdings Inc. quarterly report. CADRE Holdings Inc. offers a diverse range of businesses and services that cater to various industries and sectors. The company's product segment includes body armor, survival suits, bomb suits, duty gear, communications equipment, forensic products, firearms cleaning solutions, crowd control products, uniforms, optics, boots, firearms, and ammunition. In addition to its product offerings, CADRE Holdings also provides design, manufacturing, and service capabilities for specialized equipment used in the nuclear, defense, and oil and gas industries. This includes vessels, precision components, remote handling systems, and other related services. The company serves a wide range of customers, including first responders such as law enforcement, fire and rescue teams, explosive ordnance disposal technicians, emergency medical technicians, fishing and wildlife enforcement agencies, and departments of corrections. It also caters to federal agencies like the U.S. Department of State, U.S. Department of Defense, and various foreign government agencies. CADRE Holdings sells its products through multiple channels, including direct sales force, distribution partners/agents, online stores, and third-party resellers. The company's extensive product portfolio and global reach make it a significant player in the safety equipment and related products market. CADRE Holdings, Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $6 billion. CADRE Holdings, Inc. trades at a higher price-to-earnings ratio of 34 times and a higher price-to-book ratio of 3.76 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 59% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that have impacted sales figures over a given period. Revenue growth is primarily driven by several key factors, including a significant increase in net sales, which rose by $25,323, 19.4%, from 2025 to 2026. This growth was also fueled by the sale of physical products and long-term contracts, with performance obligations satisfied over time. Furthermore, recent acquisitions played a substantial role in driving revenue growth, with the acquisition of EOD Products contributing $87.1 million to the company's bottom line. In contrast, revenue decline is attributed to several factors, including a 10% decrease in sales from U.S. state and local agencies. The distribution segment also experienced a significant decline, with net sales decreasing by $7,600 million due to lower demand for hard goods. Additionally, existing nuclear products saw a decrease in demand, while U.S. armor products and EOD products faced challenges related to order timing. The financial performance of the company underwent significant changes between 2025 and 2026. Net income experienced a substantial decline, decreasing by 21% from $9,248 to $1,975. This downturn was primarily attributed to increased expenses such as compensation, interest, transaction, and related party costs. Profit margins also suffered, with gross profit margin declining by 5.1 percentage points from 43.8% in 2025 to 38.7% in 2026. Operating profit margin decreased even further, dropping by 1.9 percentage points from 4.9% to 3%. The product segment was particularly affected, with its gross profit as a percentage of net sales decreasing by 451 basis points due to increased inventory step-up amortization and unfavorable product mix. The distribution segment also experienced a decline in gross profit margin, dropping by 196 basis points, mainly due to an unfavorable mix. These changes indicate that the company faced significant challenges in managing its expenses and maintaining profitability during this period. The company is indeed generating positive operating cash flow. This is evident from the net cash provided by operating activities figures for both 2026 and 2025. In 2026, the company reported a net cash of $22,521,000, while in 2025 it was $17,391,000. Both years show a positive operating cash flow, indicating that the company is generating sufficient funds from its core operations to meet its financial obligations. The company's financial situation has undergone significant changes in terms of its debt level and interest expenses. A notable increase in long-term debt was observed, with a 20% rise from $290,987 to $349,567. This trend continued, with the debt level increasing from $307.3 million to $365.8 million over the same period. Furthermore, the company's interest expenses have also seen a substantial surge. The net interest expense increased by 91.4%, rising from -$2,231 in 2025 to -$4,271 in 2026. Additionally, interest expenses have grown by $2,040,000. By March 31, 2026, the company's interest expenses had reached $64,953,000. These changes indicate a significant shift in the company's financial landscape, with both debt levels and interest expenses experiencing notable increases. The company's performance across various segments has shown a mixed trend. On the positive side, the product segment has demonstrated growth, with gross profit increasing by $6,066 from 2025 to 2026. This indicates that the company's products are in high demand and have been priced effectively. On the other hand, the distribution segment has struggled, with a decline in gross profit of $2,033 over the same period. This suggests that the company may need to reassess its distribution channels or strategies to improve profitability in this area. Management statements suggest a positive outlook for the company, driven by recent acquisitions. The TIER acquisition is expected to bring synergies and additional growth, with revenue from TIER already contributing $15,479 to the product segment in the first quarter of 2026. This trend is also reflected in the increase in net sales and orders backlog, which rose by $25.3 million and $165.6 million, respectively, as of March 31, 2026. The financial performance has also improved, with adjusted EBITDA increasing by $0.6 million due to higher gross profit from recent acquisitions. These developments indicate that the company's strategy is focused on leveraging its acquisition-driven growth to drive profitability and revenue expansion. Overall, management's comments convey a sense of optimism about the company's prospects, driven by the successful integration of new businesses and their positive impact on financial performance. The company's financial performance is reflected in its dividend distribution. According to the provided information, the company has indeed paid dividends in recent years. Specifically, it is mentioned that dividends were distributed in 2026 and 2025, indicating a consistent practice of returning profits to shareholders through this means. This suggests that the company prioritizes rewarding its investors with a share of its earnings. Concerns about inventory buildup or supply chain disruption. There are indications of potential issues with inventory management and supply chain efficiency. A decrease in inventories on page 7 suggests that the company may be struggling to manage its stock levels effectively. Conversely, an increase in finished goods and raw materials/supplies inventory from December 31, 2025 to March 31, 2026, pages 17, could lead to inventory buildup concerns. The orders backlog increased by $165.6 million as of March 31, 2026 compared to December 31, 2025, page 28, which may indicate that the company is facing difficulties in meeting demand or managing its supply chain efficiently. Furthermore, a significant increase in cost of goods sold in 2026, 28.8% higher than in 2025, and a decrease in product segments gross profit from $56,176,000 in 2026 to $50,110,000 in 2025, page 29, suggests that the company is struggling with cost control. These findings collectively point to potential issues with inventory management, supply chain efficiency, and cost control. That concludes the financial summary for CADRE Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.